Jayant Acharya, Joint Managing Director and CEO of JSW Steel, joins us now. Mr. Acharya, good morning. Standalone volumes were lower in Q3 and they were impacted by both lower exports and muted domestic sales. Would you call it a structural weakness in the incremental demand or it is just transient?
So just to highlight on our performance for quarter three, we have done a very strong production performance in quarter three, 6.87 million tons, which was the highest so far in JSW Steel, both in Indian and overseas operations. On the sales side, we did 6 million tons, which was quarter on quarter minus 5%, but it was 7% higher YOY. The primary reason for the drop quarter on quarter was lower export sales because the global markets were weaker, and that's why the export numbers were weaker, and higher imports coming into India, which affected the retail sales. However, our sales to institutional customers, to OEM, industrial, was at an all-time high. Our automotive sales, our sales to the renewable industry and to the packaging was the highest in this quarter. So we maintain our focus on all our industrial and institutional customers and continue to do well in those. It's only, I think, a limited impact of the sentiment and imports, which resulted in a channel destocking in retail and a drop in exports. However, we are seeing improvement in global steel prices in the last few weeks, and that would lead to a close to domestic parity on prices. So therefore, the imports are likely to go down. And it will also encourage more export volumes out of India as there is attraction in terms of prices internationally, which has gone up.
Right, morning. Now, realizations too have been muted this quarter. Steel prices since the month of October as well have been on a declining trend. Question is, where do you see steel prices headed given China's government stimulus?
So China, as we all know, on the property sector has been weaker, but the other sectors, including the infrastructure, manufacturing, renewable, etc., have done better. Automotive sales have been at an all-time high. So they have been able to balance out the shortfall in the property sector. China is providing targeted stimulus, and we are expecting more policy measures in the first half of this year, which they will take to support their economy. So that should improve some part of their domestic demand. That would reduce, therefore, the exports out of China. Having said that, I would also like to point out that the raw material prices are elevated, and therefore the margins, even with China, is under strain. And therefore, we are seeing prices going up internationally. China, Europe, US, we have seen prices move up. We feel that this would be reflected in the coming months in India as well. And with the seasonally stronger quarter, we believe that India demand perspective also will do better.
Right. So that import competition that you talked about, any initial signs of a reduction in competition from imports then?
I would say that probably early days, but we are seeing the bookings have gone down because the parity, as I said, domestic steel prices are close to parity of international prices. And therefore, at this level, it may not make practical sense to import.
Right. Raw material costs too have started rising. Your standalone EBITDA per ton fell about 13% sequentially. What's the outlook then on raw material pricing trends and your spreads for the next few quarters?
Our EBITDA was 7,180 crores with EBITDA per ton of close to 12,000 rupees, 11,957 rupees per ton on a consolidated basis. Our margin stood at 17.1%. Our India operations per ton was also very similar at 11,900 rupees per ton and not very different from our console. Our overseas operations in this quarter three, have done quite well. And both from US and Italy perspective, they have contributed positively to the EBITDA. And that's why you're seeing a marginal uptick in the console. Indian subsidiaries overall also have done well. So from a per ton perspective, difficult to comment, but the way I would like to put it is that in quarter four, we see that the iron ore prices and coking coal prices remain elevated, and that would increase our costs and put pressure on the margin. However, from a volume perspective, we expect Q4 to be better because it's a seasonally stronger quarter. The export volumes are now picking up with better realizations, and we expect that the global steel price increase will reflect in India in the coming month to some extent. So therefore, it will partly offset the cost increase, which we are likely to see in Q4.
You've scaled back your capex guidance for the full year. What is the reason?
No, I have not scaled it back. I would say that if you were to look at the capex spend, because there is an election in the interim, the capex spend for one quarter may be slightly lower because there'll be an interim budget. But we see the direction of the spend being quite strong. That would continue post the elections. And the general activities of manufacturing will continue. So we'll see automotive, renewable, and other spaces being also quite strong. So I've not scaled it back. You may have a small disruption. You may have a consumption spend increase. But on the capex side, there may be some, I would say, delay during the period of the election in the interim. That's all.
Right. Now, the last time you categorically said that you will be looking at strategic assets and that you have given an EOI for NMDC Steel. What's the update here? What's the progress?
No, nothing additional information as such. I think it is more or less similar. On the coking coal side, we continue to scout for assets and are looking for assets in various parts of the world, including Canada, Australia, Mozambique, and elsewhere. We will certainly give you an update as and when we have more clarity on that.
Sure. Any interim budget expectations that you may have for the sector?
So I would say this is an interim budget, so we will have to look at it like that. But I would basically feel that the government would continue their public capex, which they have been doing on infrastructure, because that has been growing the economy quite well. A focused approach on improving manufacturing through self-reliant India, Atmanirbhar Bharat, and that has stood us in good stead. I would expect that the government will continue their focus in this direction and progress. That will continue to improve the steel consumption in the country. The per capita income is also rising with an inclusive growth, which we are seeing across India. The rural footprint now, I think, is showing some improvement. Two-wheeler sales are improving. Manrega demand has gone down a bit. While I think in terms of fast-moving consumer goods, it is still been a little slower, but I think we are still seeing pickup there. So therefore, we would expect the government to continue that track. On the import side, which you asked, I think our concern is that India is an outlier in the world today. The economic growth in India momentum is quite strong, and that is reflected in the steel consumption in India. We would like to be cautious about cheaper imports coming into India at unfair prices. And I think the government would need to probably look at those and look at appropriate measures to see that it doesn't hurt the domestic industry.
Okay. Thanks so much then for taking time out and giving us a sense as to what the outlook is. And that's really the word coming in from the management of JSW Steel.